Hello smart traders. In this tutorial video I will explain how our premium scripts work and all of the new and old filters. When I get to the new filters, I will explain what problems I faced during trading and what filters and solutions we came up to solve those problems. Along the way I will also give you some ideas which I think might be interesting and useful for all of you. Make sure you reload the premium scripts on TradingView as some final modifications, bug fixes and tooltip updates have been added. I recommend you watch the whole video so you will be able to use the TradeSmart premium scripts at their full potential. I will leave timestamps or chapters in the description so you can review any filter or option easily. I will also create a chat in our Discord channel so you can ask anything about what you will find in this video. Or you can start brainstorming about ideas, methodologies with me and the other smart traders. If you not have access to the premium scripts yet, you can get access to them by becoming a Smart Trader tier member on our Patreon page. Besides that, if you have a strategy you want to get coded into a TradingView script, you can now send us an email to tradesmart224@gmail.com and David or PineScript Coder can help you with that. Okay, let's get right into it. Our premium scripts are mostly uniform in regards of filters and extra options. The only difference is the main logic of each strategy. So I will explain the uniform functions using only one script. This script is going to be the Triple EMA or TEMA premium script. First, let's separate the functions of the scripts into different groups. On the top of each script you will find the base logic settings that are specific for that script. Under that you can find the next big group, the trade management settings. Here we have the stop loss, take profit setups and more. Under the trade management settings we have all the different filters. Under those we have the date, day and sessions limiters. And finally on the bottom, the trading bot automation settings. So we have 5 main groups. Now let's go over them one by one. I won't explain the first group, the basic logic group, as you are probably familiar with them if you watch the script release videos. If not, I will link videos to all of our scripts in which I explain what's the base logic for each script and how you can set it up. The second group is the trade management group. This consists of the following sections. Let's see the first section, the exit strategy section. Here you can find all the stop loss methods our scripts have. Currently you can choose from the ATR based, candle low high based, percentage based and the pip based option. Let's see how my favorite, the ATR based stop loss works. As this is my favorite stop loss indicator, I will explain it in great detail. To use the ATR based stop loss, you have to tick the box next to it. First, I set up a basic position with a 3 base risk multiplier and a 1:2 risk to reward ratio. If we take a look at the chart, you can see different trade entries and 2 lines after each entry. In case of a long position, the red line represents the stop loss and the green represents the take profit. In case of a short position, the blue line represents the stop loss and the purple line the take profit. To see where the ATR stop losses are placed, open up the Indicators tab and type in NNFX ATR. Click on this one. The ATR is short for Average True Range. This indicator measures the candle's average movement. If the ATR's length is 14, which is the default, then it measures the last 14 candles' average movement range. Then the NNFX calculates the average movement and prints a line above and below each candle with the same distance value using the candle's closing price as the 0 level. If you take a look at the NNFX ATR settings, we have 3 values we can change and the smoothing option. The X value represents the ATR length, the TP value the take profit multiplier, and the SL value the stop loss multiplier. To replicate the setup we use in our Triple EMA script, set the SL value to 3. Then, as we are currently using a 1:2 risk to reward ratio, set the take profit value to 6, as 2 times 3 equals 6. Now if we look at the long entry example, first you can see a long signal text. This is a candle on which all of the requirements are met for a long entry. So the strategy will enter into a position on the following candles open. Under the long signal candle, the red line is the NNFX ATR line stop loss line, and as you can see it matches exactly with our script stop loss line. Above the long signal candle, the blue line, which is the NNFX ATR's take profit line, also matches with the script's take profit level. If we go back to the script and change the risk to reward ratio to 3, then we have to set the NNFX ATR line's TP value to 9, as 3 times the base risk, which is 3, becomes 9. If you've done that correctly, looking at the chart you can see that the NNFX ATR's take profit line is perfectly aligned with the script's take profit level. Let's move on to the second stop loss option, which is the candle low high base stop loss. So first, untick the ATR base stop loss and tick the candle low high base stop loss. Make sure to set the base risk value to 1, as this works as a multiplier for each stop loss option. The candle low high base stop loss will put the stop loss to the lowest or the highest price value of the last X number of candles. This stop loss has only one value, which is the candle lookback. If we set this value, for example, to 10, then the strategy will put a stop loss to the lowest point out of the last 10 candles in case of a long position. In case of a short, it will put the stop loss to the highest point of the last 10 candles. Let's see an example. Here is a long position. Now click on the measure tool and measure 10 candles backwards, starting with the signal candle. Now if we look for the lowest point in this range, you will see that the stop loss level is placed exactly at the lowest point of the last 10 candles. In case of a short, it will look for the highest point of the last X number of candles to place the stop loss at. This stop loss is very simple, so let's move on. For the next stop loss, untick the candle low high base stop loss and tick the percentage base stop loss option. This stop loss option will place the stop loss at the set percentage difference using the close price of the signal candle or the open price of the entry candle. To understand, let's set the percentage value to 1% and see an example. Keep in mind that the base risk multiplier should be set to 1. Here is a short position. If I take the measure tool and start measuring upwards, starting from the entry signal candle open until the placed stop loss, you can see that it is placed exactly 1% above the entry signal candle. If I set the percentage value to 2 and measure the difference again, you can see that the stop loss is now placed at a 2% distance from the entry signal candles open. Finally, let's see the last stop loss method, the pip-based stop loss. Pip-based stop losses and take profits are mostly used by forex traders. Personally, I never use this one as I prefer the ATR or the percentage-based stop loss. Basically, 1 pip is the lowest movement a pair like the Euro-USD can move. With this stop loss, you can set the pip value, which controls the pip distance from the entry level where the stop loss should be placed. Therefore, the higher this value is, the further the stop loss will be placed. Under the stop loss options, we have the base risk multiplier and the risk to reward ratio. With the base risk multiplier, you can multiply how far the stop loss should be placed. For example, if you are using a 2% percentage-based stop loss and the base risk multiplier is 1, then the stop loss will be placed below or above the entry level by 2%. But if you use a 2 base risk multiplier, now your stop loss will be at a 4% distance, because 2 times 2 is 4. The risk to reward ratio setting is self-explanatory. If it is set to 1, then your risk to reward ratio will be a 1-to-1, so the script will risk to lose 1 unit to make 1 unit. If it's set to 3, the risk to reward ratio will be a 1-to-3, so the script will risk 1 unit to make 3. Next up, we have the force exit options. First, you can choose the force exit after this many candles option. As always, if you want to use an option, tick the box next to it. With this function, you can control how long you want to stay in a trade. Let's say we set this value to 10. Now looking at this long example, you can see that the strategy entered into a position right on this candle's open. Starting with this candle, the script is in a long position, so this candle will be the first candle. If we check where's the 10th candle from this one, you can see that that is exactly this one. As the strategy is set to exit the position 10 candles after the entry candle, it means that after this 10th candle has been closed, the strategy will exit the position on the next candle's open. It doesn't matter if neither the stop loss or take profit levels were hit, as we force the strategy to exit 10 candles after the position entry. You can play around and create some interesting strategies with this option. Here are a few examples. For example, if you want to see if a strategy closes in an overall profit after X number of candles, just set the stop loss and the take profit levels to pretty high value like a 30 base risk and a 1-to-5 risk to reward ratio. This way, it's almost certain that neither the take profit or the stop loss will be hit, and you can start testing different force exit candle values like 3, 10, 50, and so on. In the Discord chat, you can find a strategy optimization in which I use the Bitcoin USD 1-hour chart and the 48 candle force exit. But how else this function can be beneficial for us? Let's say you created a strategy optimization and you opened up the performance summary tab. You saw that the average bars in trades of winning trades are, let's say, around 10. But the average bars in trades for losing trades is around 20. What this suggests? It suggests that probably closing out the trades after 10 candles might be a good idea to avoid some of the losing trades. Another interesting idea I just had is that it might be easier to predict a trade's outcome after one or few candles than to predict after 50 candles have passed. Although this is just an idea, I haven't tested it yet. Moving on, you have other force exit options, like to exit every trade if a specific session opens or closes. Let's see an example. Let's say I optimized the strategy and found that when the New York session closes and the volume drops, the outcome of the strategy that are still open in that period becomes unpredictable. So I want to exit every position when the New York trading session closes. To make this happen, tick the box next to the force exit after New York session close. The New York session is from 8 AM EST till 5 PM EST, so I set the chart's time zone to the New York session zone. I will mark a few New York session closes so it's easier to see when a trade's closed because of the New York session. Here is an example. As you can see, the trade has not reached neither the stop loss or the take profit levels, but the position was closed. And that's because we set to exit every trade that are still open on the New York session's close. The exit on session opens works similarly. The only difference is that they will close positions as session opens. Finally, we have one other forced exit option, which is the forced exit based on squeeze momentum. Let's tick this option and see what happens. To visualize how this works, add the squeeze momentum indicator by Lazy Bear to your chart. Okay, what this function does is that in case of a long position, it will close the trade off when the squeeze momentum turns from green to red. In case of a short, the opposite is true. So a position will be closed when the squeeze momentum turns from red to green. Keep in mind that the basic stop loss and take profit levels will be still valid, so if either of them gets hit, the position will be closed. One thing that can happen, and I have to note, is that there are occasions when the script is in a long trade and the squeeze momentum was already in red color when the entry occurred. In this case, the strategy won't exit the position right away. It will wait for the squeeze momentum to turn to green and then turn back to red. However, if this won't happen, the trade will either hit the take profit level or it will get stopped out at the stop loss level. Opposite goes for short positions. If you want to see how well the squeeze momentum works as an exit indicator, use a big stop loss and the take profit so the trades are unlikely to hit either of them. Basically, the squeeze momentum works here as an exit signal indicator. In our next bigger script update, which can be anywhere from half a year to a year from now, we plan to include many exit signal indicators, so if you have any recommendations, feel free to suggest it here or in the Discord channel. Finally, we have one last option in this section, which is the move stop loss to break even. With this function, you can move the stop loss to the entry price level after the price have moved into the trade's favor with at least the set amount. Currently, you can choose from three options: the percentage based, the pip based, and the ATR based. First, let's set up the percentage based. Now take a look at the trade and let's find what is the percentage move when we want to move our stop loss to break even. Here's a long entry. If I start measuring from the entry level upwards, I would say that after 0.5% movement is the place when I prefer moving my stop loss to break even. So let's set it up. To move the stop loss to break even after 0.5% is reached, set the value to 0.5. Also make sure the percentage based option is selected. Finally, tick the box next to this option to activate it and let's see the trade. As you can see, the trade moved into our desired direction with 0.5% on this candle, so on the next candle's open, the strategy updated the stop loss to the break-even entry level. The pip-based option works the same just with pips. When you use the measure tool, the pip distance is displayed in the top right corner. Let's say I want to move the stop loss to break even after 2000 pips distance has reached. To make this happen, change the calculation based on value to pip based and type 2000 in the value field. Back to the chart. On the same trade, now the stop loss was moved to break even right on this candle open, so let's measure if the calculation is correct. As you can see, 2000 pip distance was reached on this candle, and on the next candle's open, the stop loss is now updated to the break even entry level. So the calculation is good indeed. I have to note that if you are creating a strategy to work on multiple time frames, you have to forget using percentage based and pip based calculations. That's because a 2% movement is much more common and easier to achieve on a 30-minute chart within the same number of candles than on a 15-minute chart, as the price has double the amount of time to make that move on the 30-minute. The only option for move stop loss to break even, which is designed for multi-time frame optimizations, is the ATR-based one. As I said earlier, the ATR calculates the average price movement that a candle has on the given time frame. Therefore, no matter on which time frame you use the ATR, as the ATR will base its calculation on the candles of the given chart. That's why I use ATR-based stop losses most of the time. So finally, to use the ATR-based move stop loss to break even function, first let's find at which ATR value we want to move our stop loss to break even. The way it works is a bit more complicated. As I mentioned it earlier, the stop loss levels are based on the values of the signal candle. So at this trade, the lower red line under the long signal candle is the base for stop loss level. The calculation for the move to break even function is based on the values given on this signal candle. So if I want to find which ATR multiplication to use, I have to adjust the NNFX ATR until the upper blue line is at the desired move to break even level. To do this, go into the NNFX ATR settings and change the TP value, which is the blue line's multiplier. You should increase this TP value until the upper blue line is at the desired level above the signal candle. In my case, this value is a 1.5. Back to the script settings. Take a look at your basic stop loss setup. In my case, it's a 14-length RMA smoothed ATR, so that's what I want to use at the break-even setup. And as my desired move to break-even level is after 1.5 times the ATR distance has been reached, I set the ATR factor to 1.5 and change the calculate based on option to ATR based. Now let's see if it works the way it should. If I put a horizontal line at my desired move to break-even level, you can see that it was reached right on this candle. On the next candle, the stop loss is updated to the break-even level, so it works perfectly. With that, we went over the first subsection of setups. So now we can move on to the second section, which is the trading stop loss section. Keep in mind that the trading stop loss only works if the trade on all signals function is disabled. Here we have two main options: the enable trading stop loss and the exit partially. First, let's go over the simple trading stop loss setups. If you want to use a trading stop loss, you can choose from 4 different types: the MA or moving average based, the SSL based, the ATR based, or the distance based. First, let's see the MA based type. If you are using this type, you can configure 3 fields: the MA type, the MA length, and the MA source. If you click on the MA type field, a lot of different moving average types will pop up. These moving averages were discussed and ranked in the best baseline indicator video. If you want to know more about that, I will leave a link down in the description for that. But now, for example purposes, I will use the exponential moving average, or the EMA. Moving on, with the MA length section, you can set the length of the moving average, and with the source, its source. Let's use a 100 length closed source DMA. To enable the trading stop loss, tick the box next to it. If you take a look at the trade example, you can see that we have a stop loss line, the EMA in this case, which moves up with the price. But the take profit level disappeared. That's because when using a trading stop loss, the strategy will exit the position when the trading stop loss or the original stop loss gets hit. With this trade example, that happens right here. As you can see, the price touches the EMA, so the position gets closed. But what if we only want to exit the position when the price crosses and closes under the EMA? You can also do that with our scripts. If we go back to the trading stop loss setup and scroll down, on the bottom you can see the only exit if price crosses under or over the trading stop loss. If we tick this box and go back to the chart, you can see that now the script did not exit the position on the candle as it did before, because that candle only touched the EMA but not closed under it. A few candles later, the price crossed and closed below the EMA, so the strategy closed this position. You can use this function with the EMA, ATR, and distance-based trading stop losses. You also have the option to set up a 2-step partial take profit. If you tick the exit partially with this percentage option, you can decide what percentage of the total position size you want to close at the first take profit. For this, I would recommend to use anything between 20 and 70%. This function adds an extra safety to your trading, as the script will take profits on the way up in case the trade turns against you. Now let's set the partial exit to 50%. To set where the partial take profit level should be, go back to the exit strategy settings and set the risk to reward ratio for the value you want to have the partial exit. I usually use anything between 0.6 to 2. Now let's use a 1.5. Looking at the trade example, you can see that we got back our simple trade profit level line. We also have the basic stop loss line. Once this take profit level gets hit, the strategy will close off 50% of the position and let the rest ride until the trailing stop loss gets hit. Okay, let's see the other trailing stop loss types. Untick the partial exiting and change the trailing stop loss type to SSL. With using this trailing stop loss, you can change one value, the SSL length. The SSL is a simple two-line cross indicator. I did a few strategies with it in the past, and it is used as a main entry signal in one of our premium strategies. To visualize, let's add it to the chart. Open up the Indicators tab and type in SSL. Click on this one. When the green line of this indicator is above the red line, then the SSL channel indicates a bullish momentum, and when the red line is above the green one, it indicates a bearish momentum. When the green line crosses above the red one, it is a buy signal, and when the opposite happens, it is a sell signal. So, as we are now using this indicator as a trailing stop loss, we will exit a long position when a sell signal appears, so when the green line crosses below the red one. And the opposite goes for short. Let's see the example trade. As you can see, the position is open until this point when the SSL channel crosses down, giving a sell signal, and that's when the position will be closed. Just like with the squeeze momentum forced exit, it can also occur that in case of a long entry, the SSL already gives bearish momentum signals, or in case of a short, bullish momentum signals. In this case, the script will use the original stop loss until the SSL switches to bullish momentum in case of a long, or bearish momentum in case of a short. And that's when the strategy will start using the SSL as a trailing stop loss. Let's move on to the ATR-based trailing stop loss. With this trailing stop loss type, you can modify the ATR length, the ATR factor, and the ATR smoothing. As you might know, this is my go-to trailing stop loss type, and I almost always use it when optimizing a strategy. So let's set it up, and I will use the same values as I used with the basic stop loss setup, which is 14 length ATR with RMA smoothing and a 3 multiplier. To explain how it works, I will use the NNFX ATR again. First I check if the SL value is set to 3, then I untick the buy TP, sell TP, and the main ATR functions. Let's mark the signal candle with a vertical line, then hide the strategy script. Now I will draw up how the ATR trailing stop loss works while explaining. As I said earlier, the basic stop loss in case of a long position will be placed under the long signal candle. Then, as we are using an ATR-based stop loss with the same settings, the stop loss will be updated every time the lower ATR has moved to a higher level. So, the trailing stop loss will follow this path. Let's disable the NNFX ATR and enable the script so we'll see if it works correctly. As you can see, the stop loss line follows the same path I drew. In case of shorts, it works the opposite, so it uses the upper NNFX ATR lines, and the stop loss gets updated when a new low ATR level is printed. Finally, let's see how the distance-based trailing stop loss works. If you are using this type of trailing stop loss, you can set the source of the distance and the percentage distance. This trailing stop loss were similar to the ATR-based. Let's say we set the distance source to close and the distance percentage to 2. The script will calculate the percentage difference from the close of each candle in this case, and update the stop loss according to it. Let's see how it looks on the chart. Okay, here is a long entry with the basic stop loss. As you can see, the stop loss was not moved higher until this candle, and that's because the candles have not moved high enough for the percentage distance based stop loss to be above the base stop loss level. We can use the measure tool to confirm it. On the entry candle, as you can see, the 2% distance is way below the base risk. Checking the first candle when the stop loss was updated, you can see that the new stop loss is exactly 2% below the candle. This is another great trading stop loss type, but keep in mind it's not compatible for multi-timeframe optimizations. And that's the end of the second section. Let's move on to the third, the DCA or dollar cost average section. This section is one of the main functions of the new script update. Probably all of you are familiar with what dollar cost averaging is, but if not, here's a quick explanation. Let's say you buy 10 contracts of an asset at $100 price. Then the asset goes down to $50, so you think it's a good idea to buy some more as you think the price of the asset will go higher. So you buy 10 more contracts at $50. What you just did is dollar cost averaging. Now you have 20 contracts of the asset at an average buy or entry price level of $75. This section allows you to do dollar cost averaging. Dollar cost averaging is not commonly used for scalping, it's mainly used for long-term investing. So I recommend using it with big stop losses and on longer-term strategy setups. Now let's see how it works. I will set a 10 times ATR base risk with a 50 length and the same trailing stop loss. I am also changing the basic triple EMA script settings to longer-term moving averages, which are going to be the 50, 100 and 400 length EMA. I am also changing the stochastic K and D line to 50 and their lengths to 100. This is a basic long-term strategy for the 15-minute chart. Here we can see a winning long example. As you can see, first, the price started to move against the trade before its big rally up. So it would have been a perfect opportunity to dollar cost average into the position. This would have bring down our average entry price. The way to set the DCA entry is very simple. Imagine that the distance between the entry price level and the stop loss price level is 100%. Knowing this, placing the DCA entry to a 20% pullback seems a good idea. The easiest way to visualize it is to place a 1-to-1 risk-to-reward ratio position in the opposite direction to the original trade. Now if you start moving the profit part of this position until it reaches 0.2, that is going to be our 20% drop we are looking for. Going back to the DCA settings, the price level percentage represents at what price drop we want to enter. Keep in mind, we are still using the distance between the entry and the stop loss level as 100%. So we have to set this value to 20. The order size percentage means with what position percentage we want to enter at this DCA level compared to the original entry. If I set this to 100%, then the strategy will enter at this level with the original entry's position size. If I set this to 200%, it will enter with double of the original entry's position size. Let's see what happened to the trade. As you can see, a long safety 1 entry has appeared right at the 20% drop level. The position size is also correct, same as the original. Now our average position entry price is right between the entry and the first DCA entry level. You can set up multiple DCA entry levels. For example, I can set the second one to 40% drop with a 50% entry. That should give us an entry right here. And as you can see, it does. The order size is now set to half of the original order, as I set the order size percentage to 50%. You can set up to 5 DCA levels. I think that should be enough, but if you want to have more levels, let us know in the comments or in the Discord chat. With that said, we covered this section and we can move to the next one, which is the base setup. In this section, you can set up everything connected to positions and order sizing. On the top, you can choose what positions you want to allow. If you only tick the allow long entries, then only long positions will be taken. The same goes for short. If you tick both, then both long and short positions will be taken. Under that, you have the order size setups. As you can see, currently now you can choose from 5 different order size types. The cash based, the contracts based, the capital percentage based, the risk percentage based using the current capital, or the risk percentage based using the initial capital. The first 3 options are good for non-leveraged trades and the last 2 for leveraged trades. Let's go over them one by one. If you set the cash base, you can set with how many dollars, euros or whatever currency you are using you want to enter into every trade. If you choose the contracts based, you can set up a fixed contract number you want to enter into each position. If you want to use a certain percentage of your capital to enter into each trade, you can use the capital percentage option. And finally, my go-to setups. If you use the risk percentage based using the current capital, you can achieve those nice exponentially growing equity curves. The risk percentage based using initial capital is what I use when I do manual backtesting 100 times a strategy. For that, choose the initial capital risk percentage based option and set the risk value to 1. This option is great for doing strategy optimizations because the equity curve won't be exponential and you can see easily how steady and stable the growth is. So what I usually do is use the initial capital version set to 1% risk per trade and optimize until the equity curve becomes linear and as steadily growing as possible. To explain the differences between these 2 options, I made an example spreadsheet of 6 trades. On the top, you can see the risk percentage with current capital based option. With this example scenario, I used $1,000 account balance, 2% risk, and a 1:2 risk-to-reward ratio. I set the first 3 trades as winners, then 1 loss, 1 win, and 1 loss again. After the first trade, the new capital is now $1,040. As this option uses the current account balance, the risk per trade will grow after a win and decrease after a loss. As you can see, the new risk per trade for the next trade is now $20.8. After the second winning trade, the account balance grows to $1,081.6. And the new risk per trade is now $21.63. Moving on, the next trade is a winner also, the account balance grows, the risk per trade also grows. On the next trade we had a loss, so the account balance decreases and the risk per trade also decreases for the next trade. Finally, the account ended up with $1,123 and $22.5 risk for the next trade. Now let's compare this version to the risk percentage initial capital based option. I use the same setup for position sizing and trade outcomes, so we can compare the two easily. After the first win, the account grows to $1,040, which is the same as before, but now the risk for the next trade stays at the same $20. On the next winning trade, the account is now at $1,080, and the risk for the next trade is $20. Now you can see some difference. The current capital version made slightly more profit as the risk per trade increased. Basically, higher risk, higher profit. With the initial capital version, the risk per trade will stay at the constant $20 level. After the last trade, on the initial capital version, the account balance is now at $1,120. And on the current capital version, it is $1,123. So overall, the current capital version won. But keep in mind, with the current capital version, you will have bigger drawdowns than with the initial capital version. Finally, here is an example with the strategy optimization I did earlier. On the top, you can see the results when I use the current capital-based option, and on the bottom, when I use the initial capital-based option. To sum up, I recommend you to use the initial capital-based option for optimizing and creating a strategy. But when you are finished, change it to the current capital-based option and adjust the risk percentage until the max drawdown is not more than 10 to 15%. I will talk about it in more detail in the upcoming How to Optimize video, but for now that's enough. Let's move on. The next section is the dynamic order sizing option. This feature is more difficult to understand, so pay close attention and feel free to rewatch this part if it's needed. To explain how it works, add an ATR with an ATR-based EMA to the chart. I will use a 50 ATR length and a 20 length EMA. When I came up with this solution for position sizing, the main idea was that when candles get relatively big compared to the average candle size, the ATR also becomes bigger. This means that the take profit level will be further than usual if we are using a simple ATR-based base risk and risk to reward setup. Generally, we can say that the further the take profit level is, the least likely it will get hit. Imagine this setup. We have a buy position on an asset at $100 price level. We set 4 take profit levels with a 25% position percentage exit at each level. So the first take profit level will be at $125, the second at $150, the third at $175, and the fourth at $200. What do you think? Which take profit level is the least likely to get hit? If you think the $200 price target, you are correct. So, if we were to take 100 trades like this, the fourth take profit level, which is the furthest, is the least likely to get hit. So what should the strategy script do if a trade setup price target is much further than usual? As it is less likely that the price target gets hit, we can say that it is a riskier bet. So we should decrease the position size. This is the main logic behind this option. Now let's see how we can do this using our script. As I said, we want to decrease the position size when the ATR value is higher than the average. That's why I set up an EMA with an ATR source on the ATR indicator. This EMA shows the average ATR value. When the ATR line goes above the ATR-based EMA, the script will decrease the position size, as in this case the ATR value is higher than average, so the profit target is going to be further than usual. When the ATR is below the ATR-based EMA, the position size will get bigger, as now the price target will be closer than usual, therefore it is much likely to get hit. The calculation is the following. The EMA level is the 0 level. The script will measure how far the ATR level is from this EMA in percentages. So for example, if the EMA is at a 1 level and the ATR is at a 1.2 level, it means that there is a 20% difference between the EMA and the ATR. In the script there is one extra function, which is the distance weight. Going back to the example, if the distance weight is 1, then the position will get decreased in size with 20%. If the distance weight is 2, then the position will get decreased by 40%. So the distance weight is basically a multiplier for the percentage difference between the EMA and the ATR level. Okay, but what happens when the ATR is above the EMA and the distance between them is 100%? In this case, the trade will be eliminated as the position size would be 0. On the top of this section you can also find a field named Invert Dynamic Sizing. If this is set to no, then the dynamic order sizing will work the way I just described. If it is set to yes, then it will work exactly the opposite way. So when the ATR value is above the EMA, the position size will increase, and when the ATR is below the EMA, the position size will decrease. Moving on, the next function is the avoid trades when the commission is percentage of the estimated profits. This function is very useful on lower time frames, because when you are optimizing a strategy for a low time frame, like the 5-minute, the effect of fees gets much higher. It can happen that the fees take away 30% of the estimated profit instantly. To deal with this problem, you can use this function. Let's say we are using a 0.1% fee per trade, and we don't want to enter into trades where the fees are higher than 20% of the estimated profits. For this, type in 0.1 to the commission field and 20 to the profit percentage field. Keep in mind that when you are using a trading stop-loss exit, this calculation will be based on the risk-to-reward ratio you set, no matter if it's not used for any position exits by the strategy. Next option is the do not enter trades near the last losing trade. One day as I have finished optimizing a strategy, I noticed that after a losing trade, there are a lot of times when the following few trades are also going to be losers. If you face similar problem, we can use this function. Let's say the last trade the strategy had was a losing one. We estimate that taking trades in the upcoming 100 candles is not a good idea, as it has a higher probability that those trades will be losing ones also. To set this up, as always, tick the box next to this option to activate it. Then type 100 into the minimum distance from losing trade field, and the script is all set. Just below this option, you have the opposite version of it. So the script can avoid taking trades after the latest winning trade for X number of candles. Finally, we reach the last section of this group, which is the enter trades on all signal. This function is self-explanatory. When the box is ticked next to it, the script will enter on all entry signals and not just one trade at a time. However, this seems a great function, but unfortunately using it limits a lot of other functions. When enter on all trades is enabled, you can't use trailing stop loss, DCA, force exits, and move stop loss to break-even functions. As always, read the tooltips carefully, as they will let you know which functions are incompatible with each other. As I like to use trailing stop losses, I almost never use the enter on all trade functions, but I'm sure there are a lot of profitable strategies that can be created with this function. Under the enter on all trade signal function, you can find the overlapping signal strategy. You only have to use it if trades on all signals is allowed. Here you can set what the strategy should do if short signal prints while the strategy is still in a long position, or vice versa. You can choose from 3 options. The first is the reduce position. This will basically add together the positive order sized long positions and the negative order sized short positions. If their sum is positive, then a lower position sized long position will be open, but if the sum is negative, then a low position sized short position will be opened. The second option is the cancel position. This function will close all of the positions when a conflicting signal appears. So a short signal prints while a long position is open, or a long signal prints while a short position is open. In my opinion, this is the most logical thing to do. The last option is the single exit many entry. This means that the strategy will enter into all the long and short positions, but when a long position exit occurs, it will exit all the long positions, and when a short position exit happens, it will close out all of the short positions. And with that said, we went over all of the subsections in the trade management group. Now we can move on to the next big group, which is the filters group. The filters goal is to eliminate as many losing trades as possible while keeping the winners. The first filter is a simple trend filter. You can choose from many different moving average types in the MA section. The length of the moving average can be set here, and the source here. You can filter for only longs, only shorts, or both. As you can see on the top, we placed 3 long filters and under those 3 short filters. If you want to filter long positions, tick the box next to it. To plot the moving average on the chart, tick the Show Long Trend filter. For example, set up a 200 length EMA. After activating this trend filter, looking at the chart, now you can see the EMA line right here. The rule is very simple. If the price closes above the EMA, the script is allowed to take long entries only. If you want to filter shorts too, scroll down until you find the Use Shorten Filter options, then click the box next to it and set up the desired moving average. Looking at the chart, you can see that no short entries are taken above the EMA and no long positions are opened under the EMA. This type of trend filtering is very common and useful, so I recommend using this filter. I usually use 100, 200, 400 and 800 length moving averages. Next up, we have the RSI, the Stochastic RSI and the WaveTrend limiters. These filters are overextended/oversold filters. Basically, it aims to avoid entering long when the price is considered overbought, and it aims to avoid entering short when the price is considered oversold. To visualize this filter, add an RSI to the chart. Open up its settings and remove the SMA plotting. Here we can see a short example that was opened after the price has made a significant move to the downside. So we would like to eliminate this entry as the short position was opened at an oversold price point. Usually when the price gets to an oversold territory, it tends to pull back in the near future. To eliminate this trade, first take a look at the RSI value right on the signal candle. As you can see, the RSI value is under 40, so if we limit taking short positions when the RSI is under 40, this trade should be eliminated. Let's do that. To do that, go back to the RSI limiter section. Make sure that the box next to it is ticked and that the RSI limiter type is set to normal. Set the RSI values to the same as the RSI on the chart. On the bottom, the script has two boundary levels. The first one is the simple RSI long boundary. When the RSI limiter type is set to normal, the script won't enter into any long positions when the RSI value is above the simple RSI long boundary. Opposite goes for a short. So the script won't enter into any short positions if the RSI value is lower than the simple RSI short boundary. If you are confused, feel free to check the tooltip as it describes how this filter works perfectly. As we are not limiting now the long trades, set the long value boundary to the maximum RSI level, which is 100. This way, all long trades will be taken. To limit shorts below the 40 RSI level, set the simple RSI short boundary to 40. Now let the script load, and then check the chart and see what happens. As you can see, that short trade we wanted to eliminate is now gone. For a long example, here you can see a losing long trade. As you can see, the price was overbought, so it wasn't a good place to enter. If we take a look at the RSI, you can see that the RSI value was over 60, so if we want to get rid of this trade and any other trades when the RSI level is above 60, set the simple RSI long boundary to 60. Looking at the chart now, you can see that the long trade has been eliminated. On the top of the RSI limiter, you can find the RSI limiter type. Currently it is set to normal, but if you click on it, you can see a reverse type also. The reverse RSI limiter works exactly the opposite way. So it will only allow long trades when the RSI value is above the simple RSI long boundary and only allow short trades when the RSI value is below the simple RSI short boundary. I recommend you to test out both of these types and see for yourself which method works the best. Different strategies can benefit from different types. A conservative long-term strategy might be better off with the normal type, but an aggressive scalping strategy can be better off using the reverse limiter. Below the RSI limiter, you can find the Stochastic RSI limiter and the WaveTrend limiter. The WaveTrend limiter was requested from Mr. Juicy, our moderator, an active member of the community, and one of our early Smart Trader members. By the way, you can also request any filter or function you miss from our scripts here in the comment section or in the Discord chat. Now I won't explain these filters in detail because they work just like the simple RSI limiter. The only difference is one of them using the Stochastic RSI and the other using the WaveTrend indicator. When using either of them, I recommend you first add the specific indicator to the chart and check the levels that seems good limit points. Also, keep in mind that the Stochastic RSI and the simple RSI moves from 0 to 100, but the WaveTrend moves from negative 100 to positive 100. Moving on the list of filters, we have the distance from MA function. This filter was included in our earlier script releases, but we redesigned it and changed the calculation method. With this filter, you can limit how close or how far from the set moving average you allow trades to occur. As you can see, you can set this filter for longs and for shorts separately. Let's see a basic setup for longs. Set the distance limiter type to normal, the MA type to EMA, and the MA length to 100. Finally, set the low limit value to 0 and the high limit value to 2. To activate it, tick the limit long using distance from MA box. To visualize it, tick the Show Limits button. If now you take a look at the chart, you can see a blue moving average and a green area below and above it. This green area represents where trades are allowed to be opened. As you can see, no trades are opened outside this green area. Let's go back to the settings. With the low limit, you can set the boundary distance that is closer to the moving average, and with the high limit, you can set the boundary that is further from the moving average. If I set the low limit to 1% and leave the high limit at 2%, now the strategy is only allowed to enter into a long position if the entry level is between a 1 to 2% distance from the 100 length EMA. If we take a look at the settings again, on the top you can see the distance limiter type here. Now we have the normal option set up, which I just showed you, but you can choose to use a reverse option. Let's see how it works. If we take a look at the chart, you can see that now the colors of the bands turned from green to red. This means that now the strategy won't enter into a long position in the red areas. So, as the name suggests, it works exactly the opposite way. Moving on, the next filter is the momentum filter. This one is a very effective filter and my personal favorite. You can find this filter used in most of my premium script optimizations. First, let's set up the indicator combination on the chart so I can explain how it works easily. Go into the Indicators tab and type in Candle Momentum. Add this indicator to the chart. Then type in Exponential Moving Average and add this to your chart. Okay, now press on the EMA and start pulling it downwards until it's on the Candle Momentum indicator. Once it's there, release it. Now the EMA is displayed on the Candle Momentum indicator. Open up the EMA settings, set its length to 50 and the source to Candle Momentum. After that, switch to the style settings and change the EMA color to white. Finally, set the momentum indicator's length to 50. The rule for this indicator is the following. Long positions are only allowed when the candle momentum line is above the white EMA line. Therefore, shorts can only be taken when the candle momentum line is under the white EMA line. Here you can see a losing long trade. If you take a look at the candle momentum oscillator, you can see that this trade would have been eliminated if we would have used this filter. And that's because the blue momentum line is under the white EMA line. Okay, now let's see how we can set up this filter in the script. As you can see, you can limit long and short trades separately. To limit only long trades, tick the box next to it and leave the limit short box unticked. With the length section, you can change the candle momentum's indicator's length. So as we use the 50, set this value to 50. With the source, you can set the candle momentum source. We will use close this time. The MA type lets you choose which moving average you want to use. As we used an exponential moving average, set it to EMA. And finally, the MA length sets the length of the moving average, so set it to 50. Now let's take a look at the chart, and after it has loaded, see if we set it up correctly. As you can see, the long trade has been eliminated, so we set it up correctly. As we activated just the limit long using momentum option, the script will only limit long trades. If you want to limit shorts also, using this same setup, set the same values at the limit short using momentum section and tick the box next to it. This 50-50 setup worked multiple times for me, so feel free to try it out with your optimization and see if it improves your results. The next filter is the candle height limiter. This filter is very simple, but it's effective. This is another one which I have used in multiple premium optimizations. You will find that many simple concepts in trading are actually effective and useful. So don't ignore filters like I am about to show you just because they look too simple to be useful. The candle height in percentage indicator helps to eliminate entries at overextended price points, and also when there is not enough price movement. To use this filter, add the candle height in percentage indicator to your chart. This indicator shows the price movement range of each candle in percentage. On default, it is set to include wicks plus body of the candles, but you can change it easily. To only make it show the candle body heights, go into the indicator style settings and untick the plot section on the top. The logic behind this filter is to eliminate entering into trades when the price has already moved too big and there's not much movement left to capture. Keep in mind, as this indicator uses price movement percentage, it is a timeframe sensitive filter, so if you plan to create a multi-timeframe optimization, try to avoid using this filter. The indicator moves from 0 on all timeframes, but the upper limit is dependent on the timeframe. For example, on the 15-minute chart, the high limit is around 2. Now let's find a losing trade example that could have been eliminated using this indicator. Here's a short example. As you can see, this signal candle had a significantly bigger move to the downside than the others. This means that the entry on the next candle's open is a bit late because a big part of the expected move has already happened. This leads to a higher risk trade with a bad risk-reward ratio. If you want to limit entering on big one candle moves, check out the height of the spikes printed by the indicator and find a reasonable limit level. As you can see, only a few candles have bigger than 1% movement, so it might be a good idea to limit trades on candles with higher movement than 1%. Let's go back to the script and set this up. On the top, you have the limit based on option. Here you can choose on what the limits should be based on. As we are now using candle body plus wicks, choose that option. You can choose from candle body or candle body plus wicks. Make sure to set up the limit based on section correctly. When the indicator prints yellow, red and green bars, it uses candle body plus wicks. But when you only see yellow columns, it only uses the candle body. As you want to eliminate trade entries when the signal candle height is bigger than 1%, type in 1 to the candle limit high field and tick the box next to it. Going back to the chart, we no longer have that losing trade, so the filter did its job right. Under the candle limit high option, you can find the candle limit low field. Originally, when I came up with this idea, I didn't want it to have a low limit for candles, but we added it anyway because you never know what can turn out to be a good filter. After I tested it, I found out that it works really well at improving a few of our scripts. So let's say I don't want to enter into any positions when the signal candle height is less than 0.2%. To do that, set the candle limit low to 0.2 and tick the box next to it. Now if an entry signal candle would have printed here, then the script would have not entered as the entry signal candle would have been under the 0.2% low limit level. In my opinion, the reason the low limit works is because when the candle's movement gets low, the momentum is usually indecisive, meaning the sellers and the buyers are equally present and they are not sure which direction the price will move. It is also possible that the volume and volatility got very low due to different market sessions. Entering into positions in these conditions is not a great idea most of the time, as the trade outcomes becomes unpredictable. With that said, let's move on. The next two indicators are very similar to each other. They are the Keltner channel and the Bollinger Bands limiter. The Keltner channel limiter limits in what price range the trade entries are allowed. To visualize, go into the Indicators tab and type in Keltner channel. Once you add it to your chart, you will see three lines, one in the middle, one upper and one lower line. These lines define our ranges. The area between the upper and the lower line is the full range. Between the upper and the middle line, we have the upper half range, and between the middle and the lower line, we have the lower half range. With the script's Keltner channel filter, you can limit in which range you allow trades. Let's take a look. You can choose to limit only long positions, only shorts, or both. If you tick the limit range function and leave the limit range short unticked, only long trades will be limited. For example, I set the limit range long to full range. You can configure the Keltner channel settings right below. The most important settings of the Keltner channel are the length and the multiplier. With decreasing the length, you can make the Keltner channel react faster to price changes. With decreasing the multiplier value, the Keltner channel's upper line gets lower and the lower line gets higher. So basically it tightens the range. Once you set all the parameters as you intended, tick the box and now entering long trades are only allowed inside the Keltner channel's upper and lower line. As I said, the Keltner channel and the Bollinger Bands filters works very similarly. The only difference that the Bollinger Bands filter uses Bollinger Bands as the base of calculation. You also have a length function here, but the multiplier function is here called standard deviation. so keep that in mind. What I found to be working most of the time is full range and a slightly decreased Keltner channel multiplier or a slightly decreased Bollinger Band standard deviation. This is a simple filter, so I won't spend more time explaining. If you have any questions, you know where you can reach out to me. Let's move on to the next indicator, which is the ADX Limiter. The ADX, or the Average Directional Index, is basically a momentum indicator. It aims to tell us how strong the momentum or the trend is. When the value increases, it indicates that the price is trending and has momentum. And when the ADX value is low, it means that the price is in a sideways price action or just slightly trending in either direction. A common way of using this indicator is to only enter trades when the ADX value is above the 20 level. In our script, you can set low limit and the high limit also. Let's see. To use this ADX filter, just like with other filters, first tick the box next to it. Then you can find the ADX indicator settings right here, and you can set the low and high boundaries here. The low value boundary will set the lowest value the ADX needs to have in order to enter into a position. The high value boundary sets the maximum value the ADX can have. I usually use a 15 low limit and leave the high boundary at 100 as that's the maximum value the ADX can have. This way, for example, this trade would have been eliminated as the ADX value is below 15 on the entry candle. The ADX filter has one extra section, which is the Use EMA base calculation. To understand how it works, add an EMA to the script. Once you have it, click on it and start pulling it down until you reach the ADX indicator. When it's there, release it. Now go to the EMA settings and set its source to ADX. Now you can see that the ADX line sometimes above the EMA and sometimes below the EMA. With the use of EMA base calculation section, you can limit the script to only allow trades if the ADX is above the ADX base moving average. The logic behind why it is good to enter when the ADX is growing compared to the moving average is that it indicates that the price momentum and the trend is getting stronger. If you want to set this version of the ADX filtering up, change the Use EMA base calculation option to Yes. Then choose the moving average you want to use at the EMA type section. Finally, you can set moving average length at the EMA length section. We only have a few filters left, so hang on. Next on the list we have the Abnormal Movement Detection filter. The main idea for this filter was that when we see big one-candle movements, it can be a sign of price manipulation. Here you can see two types of abnormal movement filters. The first one filters based on price percentage movement. With this, you have two values that can be changed. The AM candle lookback sets how many candles should be checked before the entry candle. The percentage max movement limit sets the highest percentage value that one candle can move in the last X number of candles to not be considered as abnormal movement. Let me show you an example. To make it easier reading the percentage movements of the candles, add the candle height in percentage indicator again to the chart. Okay, here you can see a long entry. This long entry had some pretty big candle moves before the entry candle, so it's a perfect candidate to showcase the use of abnormal movement filter. As you can see, here is a one big candle move that was then recovered, and we have the long entry signal candle right here. Let's check how many candles we need to look back to have that bigger candle in the range. Looks like around 10 candle lookback will be enough. Now check the candle height in percentage indicator for the height of the candle. As you can see, it was around the 1.7 move in one candle, so to filter out this trade entry, we have to set the max limit to below 1.7. Let's set it to 1.5, then tick the box next to the filter to activate it. If we check back on the trade, you now can see that it's disappeared. The other method is to filter based on movement in relation to ATR. As I said earlier, using any percentage-based filter makes the optimization only compatible with one time frame. But with the use of one ATR, the optimizations can be used on multiple time frames. It is more complicated than the percentage-based setup, but works really well if optimized correctly. So pay close attention. Let's do a basic setup and I will explain how it works. Set the candle lookback to 5, the ATR length to 14, the ATR smoothing to RMA, and the ATR factor to 2. Now go back to the chart and set the same values on the NNFX ATR indicator. After that's done, let's find a losing trade example. Okay, here is a losing trade example that had abnormal movement. As we are using a 5-candle lookback, let's mark the starting candle. The rule is the following. If any of the previous lookback number of candles before the entry candle has touched or crossed either the upper or the lower NNFX ATR line, specific for that candle, then the strategy won't enter into a position. So basically, if any of the candles have two big movements, then the strategy won't enter into a position. As you can see on this long example, 1 out of the 5 candles before the entry candle has touched the upper NFX ATR line. So this trade should be eliminated if we activate the filter using the setup I used earlier. Let's see if it happens. As you can see, the trade is no longer there, so the filter works correctly. I hope you understood the logic behind this one. If you are still confused, feel free to ask me any questions in the comments. The next filter is the target price limiter. This filter is easy to understand and use. You can see we have 3 long limiters and 3 short limiters. If you want to use either of them, tick the box next to it. The rule is simple. If the set moving average line is between the trade's entry and take profit level, then the trade will be filtered out. The main logic behind this filter is that at major moving average levels like the 200 length EMA, the price can struggle to break through and often reverses hitting the trade stop loss. To solve this problem, the script won't open any trades when the take profit level is on the other side of the set moving average. For example, let's set up an 800 length simple MA. On the 15-minute chart, this is almost identical to the 1-hour chart's 200 length moving average. Here you can see a long example. This long trade has been opened just below the 800 length MA, so its take profit level is on the other side of the moving average. In this case, the moving average serves as an effective resistance for this trade, which made the price turn around and hit the trade stop loss. But we can filter out it easily. Open up the script, scroll back to the target price limiter, and tick the first long limiter as we try to filter out long trades now. Set the type to SMA, which is the simple moving average, then set the length to 800, and leave the source as close. Back to the chart, you can see that the trade has been eliminated successfully. If you want to limit short trades, just scroll down and use the short limiters. Moving on, we have another simple filter, the round number filter. Keep in mind that this filter is not time frame sensitive, but asset sensitive. And that's because its filtering depends on the asset's price. The round number filter is similar to the target price limiter. The only difference is that it uses round numbers in price instead of a moving average. As you might have noticed, when Bitcoin gets near 20k, 30k, 40k or so on, round price levels, it can struggle to break through. For example, here is a long position that was opened just under the 40k level. After this position entry, the price tried to break through the 40k level, but it failed, then pulled back and hit the stop loss. To filter out this trade, set the round number filter to 10,000. This way, trades won't be taken when the take profit level and the entry level are on the opposite side of the 10k, 20k, 30k, 40k and so on price levels. It's a simple filter, so we can move on. The following filter is the most complicated out of all, but it has a lot of potential. It's called the candle indecision filter. Candles can tell a lot about the market sentiment. For example, when the price is in a strong uptrend, you will see a lot of strong and relatively big green candles with a few small red candle pullbacks. The opposite is true for a strong short trend. These are the points where we want to be in a trade if we are using a trend following strategy. But when the price is in a sideways price action, we want to avoid trading. For filtering entries in sideways price action, you can use the ADX, the momentum or this indecision filter. Looking at the sideways price action, what are the common candle formation that appears? What about this, or this? These are two candle formations that are very common when sideways price action is present. As you can see, it consists of two opposite color candles that are almost identical in size. These formations are what we named indecision candle pairs. With the indecision candle filter, you can filter out entries near these candle formations. As a result, the strategy can avoid entering into trades in sideways price action periods. Now let's see how we can set up this filter. With the candle lookback, you can set how far should the strategy look back for indecision candle pairs before the entry candle. The strategy in this interval will check for the indecisive candle pairs. Let's set now this to 30. Above the lookback field you can find the indecisive candle count. Here you can set the minimum number of indecisive candle pairs that the strategy should find to not allow trades. Set this now to 2. At the movement factor section, you can set how big in percentage should a candle be to be considered as indecisive candles. The logic behind this one is that very small candles are usually the result of low volume and volatility, and those are just random movements, so we don't want to take them into consideration. But candles with bigger percentage movements are more significant. Taking a look at the chart at an indecisive candle pair, you can see that their price movement from open to close is around 0.35%. So I would set the minimum value of the movement factor to 0.3%. And the last field is the indecision factor. Here you can set how big difference can be between the first candle's open and the second candle's close maximum in order to be considered as indecisive. For example, here is an indecisive candle pair. The difference between the first candle's open and the second candle's close is 0.07%. So if I want to consider this candle pair as an indecisive candle, we have to give a higher indecisive value than 0.07. A 0.1 would work perfectly. If a candle pair matches all the criteria, it will be marked as an indecisive candle pair and can lead to eliminated trades. Keep in mind that because of this filter uses a percentage-based calculation, it can be used for multi-time frame optimizations. We arrive to the last 3 indicators, which are for volume filtering. First, we have the simple volume filter, which only uses volume bars and the moving average. You can choose any moving average from the drop-down menu. For example purposes, now I will use an EMA. To visualize this indicator, add a volume to the chart. Then add your chosen moving average, in this case an EMA. Once you've done it, click on the volume and start pulling it down where the trading time is displayed. Then release it. This way the volume will be displayed in a separate window. Next step is to put the EMA on the volume indicator. So click on the EMA, pull it down to the volume indicator and release it. Now open up the EMA settings and set its source to Waddah. The rule for this filter is the following. The strategy can only enter into a position when the volume is above the volume-based EMA. Its purpose is to avoid trades in low volume areas. Moving on, the next filter is the Waddah Attar explosion filter. Probably you've already heard about the Waddah Attar, so you might be familiar with it. First, add the Waddah Attar indicator to the chart. As you can see, it has different colored bars, an orange line and a blue dotted line. When the bars are red, it means bearish momentum and volume, and when the bars are green, it is considered as bullish momentum and volume. The higher the bars are, the stronger the signal is. A common way to use it is to only allow trades when the bars are above the lines. This is also the method or filter uses. You can modify all the settings of the Waddah Attar in our scripts. You also have the option to take the bar colors into consideration. If you check out the limit trades based on trends section, you will find 2 options, yes or no. If it is set to yes, the script can only enter into shorts when the Waddah Attar bar is red or orange, and only enter long when the bars are green or light green colored. And also the bars have to be above the 2 lines for valid entry. You can modify all the other settings for the Waddah Attar right here in this section. Finally, we reach the last indicator, which is the volume oscillator. To understand how it works, type volume oscillator in the indicators tab. Add this one to your chart. This indicator has a blue line which oscillates between negative 50% and positive 50%. The higher the line's value, the stronger the volume is. With the script's volume oscillator filter, you can limit entries based on the values of this volume oscillator. You can set up 3 combinations. First, if you only tick the low limit, the script will only enter trades when the oscillator value is above the set low limit. If both the low limit and the high limits are ticked, the strategy will only enter into a position when the oscillator's line is between the 2 limits. If only the high limit is ticked, the strategy will only enter into a position if the oscillator's line value is lower than this limit. Simple as that. You can modify the volume oscillator settings inside the script. For example, here is a losing short trade that could have been eliminated with this filter. If you take a look at the oscillator's value below the signal candle, you can see that it's around the negative 3%. So if I set a low limit value of 0%, the strategy will only enter into any position if the oscillator's value is above 0%. Let's see if it works correctly. After the script has been updated, you can see that the trade has been eliminated. And with that said, we went over all of the filters in our filter section. The last big group is the date and time limiters. In this group, the first section is the date range. With this, you can set the trading time interval. So, for example, if I want to see how the script performed in January 2022, I just have to set the start date to the 1st of January and the end date to the 31st of January. To activate it, you just have to tick the limit between dates box. Moving on, the script has a sessions limiter. Probably you are familiar with the 4 big trading sessions. These are the Sydney, the Tokyo, the London and the New York sessions. Each session's open brings in big volume and often increases volatility. So for example, if you found that trading in the London sessions give the best results, then you might consider only allowing trades in the London session. To do that, you have to tick the Use Sessions Limiter box and only leave ticked the London session. Another use of the Sessions Limiter is when you found out that, for example, the Sydney session is the only session in which the strategy loses money. Then you can tick every session except the Sydney session. This way the strategy will trade in each session except the Sydney. And finally, let's go over the trading time limiters. With this limiter, you can limit the script to only allow trading on the set days of the week or even between the set hours of a day or days of the week. If you want to limit trading for only Mondays and Tuesdays, then you have to type 1 and 2 in the Valid Trading Days global section. Then just tick the Limit Trading Time box. If you want to limit trading in between specific hours, you can use the Valid Trading Hours Between section. First, you have to set which day or days should the set hours limit activate on. Then just set the hours you want to use. Once you got it all set up, tick the boxes next to these 2 sections. Keep in mind you also have to tick the Limit Trading Time section. For example, let's say I only want to take trades between 8 and 10 AM on weekdays. To do that, set the Valid Trading Hours Between section to 8 and 10 AM. Then set the Valid Trading Days to 1, 2, 3, 4 and 5. Leave the Valid Trading Days global with all the numbers from 1 to 7. Finally, tick the 3 boxes to activate the setup. You can set up to 7 different hours limiter. And with that, we went over all of the limiters in the trading date and time limiter group. Finally, you can find one last group in the script, which is the Trading Bot Automation group. I won't explain this group in this video, because David or PineScript Coder had already made a video of it and how to set it up. You can find that video on our Patreon page. If you watch this video and you don't have access to our premium scripts yet, you can get access to all of our premium scripts, tools and optimizations by becoming a Smart Trader tier member on our Patreon page. The filters and options in our premium scripts won't change in the following 6 months to 1 year, so I recommend you master this script setup. In the next private video, I will show you how to optimize a strategy starting from scratch. I will share some of my methodologies and ideas around optimizing and the way I do it. I will share a lot of valuable information, so stay tuned for it. This video will be released in October. With that said, thank you if you watched this long video. I hope you found valuable information here and that I was able to answer every question you might have. If you still have any questions regarding the scripts, feel free to ask me here in the comment section or in the TradeSmart Discord server. Have a great day and see you in the next video.